Since 2015, the Nigerian economy has been grappling to survive contending macroeconomic issues, which has continued to affect both citizens and businesses as its overvalued currency continues to translate into persistently high inflation rate, alongside a high unemployment rate and poverty that has defied all economic interventions. Currently, the rate of inflation in the country has hit 19.6%, which has generated a public outcry as the World Bank revealed that Nigeria needs to urgently introduce a robust economic reform that will address mounting fiscal pressure, boost private investment to create jobs, and also come up with policies that would address the poor living standards of its people. Well, joining me to do this is a global analyst. He's an international body person. I'm speaking to a to analyze macroeconomic issues. Is an economic consultant and a development economist, Professor Ken Ife. Prof, I must thank you for your time. Good afternoon. Prof, can you hear me? Good afternoon. All right then. Professor Ken Ife, there live via Zoom. Can you hear me? A lot for us to talk about today. The network should just be our friend. Let's see what happened. Okay, Prof, if you can hear me, what is your reaction first to the inflation figures that we had this week from the NBS? Was that what you were expecting, and what does it mean for us as a country?
No, I do expect him. I was expecting a rise, but not so sharp. But nevertheless, I expect the inflation to continue to rise above 20% and then continue until somewhere around October, end of October, early November, when we are in full harvest season. Then it will begin to stabilize. But of course, you are still going to have a spurious rise in December from Christmas expenditures, and that would be a different reason, the injection of cash into the economy from Christmas. But at the moment, it's the food sub-basket index that is driving the inflation. Last month and 2 months ago, it was the high input cost from diesel, high rise of the price of diesel and transport and power, and now it's the food sub-basket index, which was over 22%, over 2%.
Oh, guess we're having issues with the network today, and it's not always like this. Talking to Prof, I don't know what is really happening today. Prof, can you hear me? Well, I guess we'll take a break. When we return, we'll bring you more, of course. Don't go away. Tẹ́lẹ̀ àtọ́ kò kí n bad bẹ́ẹ̀ yẹn sẹ́mi mọ nǹkan tó wá ṣẹlẹ̀. We're glad to have you back. I have Professor Ken Ife via Zoom. Prof, if you can hear me, you were trying to make a point, but we had issues, of course, maybe network and all of that. But please go ahead.
Yeah, what I was saying is that the inflation is expected. there has been a shift from high diesel costs that went to nearly 400%, pressure on transport costs going up, and they had the power, of course, going up. You have all of that pushing up, and that was accounting for the last 2 months. But now the food is back again. It showed a lead of about over 2%. It's now at the food salt basket index is at about 22, just over 22%, while the inflation is 19.8. So it's giving a substantial gap. So food is back again as the driver of inflation. But what I will say is that by end of October, there will still be more rise because the inflation will go over 20% without a doubt. But by end of October, November, there will be more harvest coming out, and that will stabilize the price. But again, in December, it will jump up again, which you will see in January figures. And then you will have another steam going to be taken off immediately after the Christmas. It comes back again. And then only to jump again by April, May, because of planting season. So we are going to be in a real bumper situation with the inflation. It's going to be jumping up and down.
While it looks like it is a global issue, indeed it is, but some major drivers in Nigeria, let me just identify one or two of them, which I would like you to comment on. You've talked about transport costs, and exchange rate depreciation is something that we really contend with as a country. At the time, it was even above 700 naira at the other market. What do you think? What does this mean moving on? And of course, hike in energy prices. Diesel as of today is still above 800 naira. Aviation fuel is above 900 naira in some cases.
Yeah, well, you can see those from just over 200 naira to over 800 naira. It's almost 400% increase, a 350% increase. And then you also have, as you mentioned, the aviation fuel showing the same level of increase. And then you have all other things, fertilizer, herbicides, they're all gone up by about 200 to 300%. But what has not gone up commensurate is the food price. That is, for example, rice. If rice was to jump the way they have jumped, all these factors, then rice would have been at 70 to 100,000 naira a bag. But it hasn't. And it's just because of the massive investment of 1 trillion naira going into that area, Anchor Borrowers Program and all that. But having said that, the inflation is still going to continue to rise over the next 2 months. It's going to go well over 20%. There will be a little steam taken out of it, October, November, but it will return again in December's expenditure, Christmas festivity, and then it will only go for 2 months. Then again, as you are coming back, you now have this planting season again, which is a time of scarcity. So it's going to be very, very tough, I promise you.
Let's also look at some structural bottlenecks now to production, which is affecting us as a country. Prof, are we going to continue this way?
No, you mentioned the Forex situation. The Forex situation is very unfortunate because it has been compounded by speculation. When people are speculating on devaluation of the currency, they are buying dollar with anything they can find anywhere, even borrowing to buy dollar, because they believe that if you are devaluing in the next 2 months, then they will sit down in one place and make 20% or more. And then you have all these politicians now looking for dollar. You have dollarization of the economy with intensity. You have all kinds of spurious demands. If you look at the trade balance between Nigeria and China, it's over 2 trillion naira. What are we buying? The same frivolous items. So there is all that demand side to deal with. On the supply side, there is an imbalance because over 70% would have been coming from NNPC and our crude or gas, but it's not been coming. I know there was one payment, one of over 2 billion, but that is just like it divided over 6 months. That's only about $300 million. CBN spends $1.8 billion every month on servicing all kinds of things, servicing debts, making voucher funds available. It's not in any position to maintain that kind of level of expenditure of dollar because we don't print dollar. We still have to have all these receivables. And the other options, of course, which are the foreign direct investment, foreign portfolio investment, diaspora remittances, they've all been taking a knock, very, very serious knock. And you know why? Because America has normalized monetary policy. They have increased in, MPR rates. Inflation is quite high there, and they are going to continue. And so all the monies coming in here are heading back to earn higher interest rates in America, more stable economy, more predictable. If there's any problem, America will print more dollars. So they're not worried. But they can be worried because of what is going on in the emerging market. So you got all that tension. But the more pervasive one is insecurity. Insecurity is what discourages investment. It is investment that you need to cushion all this inflationary pressure. But that investment is not coming in because they are worried about insecurity everywhere, not only of their lives, but of their properties and investment. Then, of course, you have other structural factors that are kicking in, the power situation that has not been resolved and is costing very, very high cost. Then you have all this energy that you mentioned again, that the diesel that is powering most of the industries. I have a survey that says 68% of the industries provide power for themselves 90% of the time. And what are they using? They're using diesel. Now, diesel is 400% increase in price. So what's that going to mean to input price? Then look at transportation systems are using diesel. The trucks, the lorries are using diesel. The rail is not working. So it's not an easy time. It's a very tough time, and we're not alone. Most other countries in the world are feeling the heat, but our own is compounded by so many things: insecurity, uncertainty, speculation, and then critical shortage of infrastructure. And this is a lot to take in the Nigerian economic situation.
Well, for me, as CBN tries as much as possible to defend the Naira, supply funds for the rail sector, all of these moves, we know all of the interventions. Mine is focused on the Forex issue. Can they sustain this with the way it's going?
Well, I think CBN will be all right as long as we begin to tackle of course, you can see CBN now moving into the supply side of Forex by launching the RT $200 billion non-oil export. I think that's very logical because you can continue to manage poverty by focusing on the demand side. But you got to have an offensive posture on the supply side of the Forex. And that's what they have actually done. And all you needed to do is to get more people to rally around that program and see how we can make it work. Obviously, if we can push more, if we can get an extra 100, not even $200 billion, just 50 to 100, then it will balance our fortune on the Forex. And the banks can continue now to provide their own Forex for their customers, and they release the pressure on central bank to have to do that.
Very, very interesting and one there. So, like you've said, we'll continue to move along this line till, say, October and all of that. But when the harvest season comes, what about the issue of insecurity? Are you sure that won't affect one way or the other, and the price of foodstuff might be so much on the high side? Nigerians want to hear about that.
There are two things about the foodstuff, the price of foodstuff. We're still having some food being imported. And some of them are being smuggled through the borders. Officially, you will see CBN giving money for rice importation, but unofficially, you will still see quite a huge amount also being imported and brought in through the borders. What are they doing? They're still using dollars to place all these orders. And then you see what I've just given you, over 2 trillion trade balance with China. What are they importing? They're importing all kinds of things. The manufacturers, where your manufacturing base, about 80% are dependent on imported raw materials. You cannot starve them of currency, so you keep on giving them Forex. So the sooner we get into the adjustment table, the earlier we can get out of this. But it's not going to be very easy. It's not going to be easy. It's not going to be easy unless we'll take very, very seriously this RT $200 billion program that is focusing on beefing up all our export revenue. Now, explain to me, why would NNPC do a direct crude swap with foreign refiners, and then they now send back the refined products, and they go to ask the government to go and find extra $6 billion. That's $500 billion every month. naira to subsidize. Now you are going to borrow money which the law doesn't support for consumption. The law doesn't support that. FRA 2007 does not support that kind of borrowing. You cannot borrow for consumption. You cannot borrow to pay salary. The law says you borrow for capital expenditure and human resource development. But that's where we are being pushed into more debt. And then more debt means you have to look for dollars to finance finance the repayment of the dollar-denominated loans. And then also means possibility of higher inflation, because that is just where it's heading to. And already we have more money in circulation that we should be mopping up and using. Of course, the CBN is doing something. You've seen how they are now giving matching orders to the banks to increase their deposit ratio, the deposit rates to 4.2, which is about 30% of the base rate. Base rate is 14% multiplied by 3%. So that's how you are getting 4.2%. So that will encourage more people to begin to save their money rather than spend them, because they could save because the rate has gone up from 1.15 to a minimum of 4.2%. So that would start taking more money out of circulation. Of course, the government is going out to borrow again in domestic currency, which is again sucking out some naira in circulation. But politicians are also throwing in a lot of naira into the system. So it's a catch-22 situation.
Let's wrap up on this note. Purchasing power continues to decrease. Everything is on the high side. Let's humanize this a bit. What kind of life will, well, I know it's a global thing, but will a Nigerian live at this time? Salaries are not increasing, but everything we're buying, of course, it's increasing at the moment.
Yeah, it's a very difficult situation, actually. You would expect salaries to increase, to take into account the added difficulty. But you also need to have orchestrated action, because you see some of the candidates beginning to say, we have to plug some of the holes, we have to plug some of the leakages, and you have an aggressive package of measures from the Ministry of Finance looking to address this area of leakages, and then leakages both in the tax revenue and all of that. So they all have to come together. When you interact together, and of course, I've always said that we need to expand the list of restricted items, and then also that the Ministry of Finance should bring in levy instruments to increase the effective tax on those frivolous imports, and that will give more revenue to the government, and as well as send a clear message to the importers that that's not helpful. That particular level of import is not helpful to the economy.
It's a good way to live it. Professor Ken Ife, development economist. I must thank you so much for your time on the show. It's always a pleasure having you join us.
Thank you very much for having me.